do some other interesting things with this data. And so there's really two halves to the paper. And the first half is a little bit under construction in light of some comments we've gotten recently about some of the things we're doing. So we're reworking that. So I'll talk about that fast and get your feedback on what you think about that. And then we'll hopefully not spend too much time on that and then move into what I think are the interesting parts of the paper. So,
you guys got to do it again. There it goes.
So this is basically the two questions we talk about in the paper, which is the first is called payday loan markets work. And this is the sense of thinking about, is there a market failure in the payday loan market? And then the second question is there a government solution in some sense? So the first question is, sort of, do payday loan markets operate in a functional fashion? Are prices set by supply and demand? Or is there something about this market that causes borrowers to be systematically exploited or something like that? And then the second question is, regardless of the answer to the first question, what are the impact of some very common regulatory interventions in the payday loan market? There you go. There you go. So what this has always been intriguing to me is somebody heard this in a long area, that payday loans are a particular source of vitriol from regulators and a lot of other people, because in some sense it seems like the ultimate competitive market, right? A simple product with a single price term over a short period of time. Barriers to entry are very low. In a given market like this, there could be 5 payday loan stores within a couple of block radius, right? And so it's kind of a funny place for there to be a concern about market failure. So you see, when you ask payday loan borrowers, they tell you, yeah, payday loans are expensive. And they know they're expensive, right? So they said here, about 98% of consumers know how much a payday loan costs. But there's a sort of funny thing that you often, when you talk to people, say, did you know there are more payday loan stores in California than McDonald's? And it's like, yeah, our payday loan borrowers lucky that there's so much competition. And the most important thing here is, I think I've never been able to see that there's any evidence of supernormal profits or economic rents in this market, which is what you expect in a market that has a high degree of competition. Costs are high. It costs a lot of money to make a $400 or $500 loan. Default risk is high. And so even though prices are high, there's no evidence of economic rents. Nevertheless, during the Obama administration, the CFPB issued a payday loan rule. And this is basically the essence of the payday loan rule, which is under Dodd-Frank, the CFPB is not allowed to impose usury ceilings or a nationwide price ceiling on any financial product. So to deal with payday loans, instead what they did was they issued this rule that went after the quantity of loans. And what they really had in mind was this idea of rollovers. And the idea is that that this is what causes financial distress. The consumers, for behavioral economics reasons or some other reasons, take on a payday loan. They think they're going to pay it back. They don't pay it back. They end up rolling it over. They roll it over basically at the end of each term, racking up more fees along the way, and then they get so overwhelmed that they default or something like that. So the idea is and they rely heavily on behavioral economics in the rulemaking in 2017 of the issue. So what they do, since they can't do a price control, is they basically say, oversimplified, close enough for this paper, is you can only take 6 payday loans in a 12-month period. And beyond that, you basically can't get any more loans. They say what you're going to have to do is you have to conduct an ability to repay calculation that the CFPB calculates for you. But effectively what that means is that you wouldn't be able to get any more payday loans after you get 6 in a 12-month period. And their idea here is that it's all about ability to repay, unaffordability of the loans in the life. Then during the Trump administration, in a very interesting way, the payday loan loan rule essentially got repealed. I can talk more about that if you're interested in the legality of it. But basically, they got rid of this provision of the payday loan rule. There were some other provisions that were preserved, but it's fully expected that it's going to come back under the new leadership during the Biden administration, something like this. And it's estimated it would have a huge impact on the industry. So at least 65% of volume would be reduced. A large volume of payday lenders is obviously people who take multiple loans in a given year. And so they would say that it would reduce the supply of payday loans by at least 65%. Most people think it would be more like 80%, basically because of the economics. And the idea here is the CFPB has, in one sentence, why they did this, a sizable percentage of users report they have taken a loan on almost any terms offered. So the CFPB's view was that there is essentially no serious competition in the payday loan market because consumers basically are so desperate that they're not shopping on price or sort of any other margin. They'll just take whatever price is necessary. And that leads then into the idea that it makes sense, if you can, to impose price controls. Basically, is the idea, because otherwise prices would basically go to infinity because they could basically abuse you. Do you have a question?
Yeah, did they think through who these people would be getting their loans from after they shut down the payday lending? Was that ever in the...
Not in any serious way. They talk about it, but and we'll talk about that later on, which is if you reduce, where do these people go?
That's the other point.
Yeah, that's what history tells us.
But it's equivalent to the FDA saying, you can only buy 10 cigarettes a day.
Yeah, right.
And you know, people get the cigarettes.
10 cigarettes a day, but we're not going to limit smokeless tobacco.
Exactly.
For example,
Yeah.
right? Or whatever the case may be, right? And so we know where these people go, which is you're payday loans, they use bank overdraft protection, for example. They use pawn shops, right? And so you still do have the question of where do they go, and this is why in the past these things have always failed. And eventually they end up with Fat Tony on the corner, which is not purely lore. It's not that I was watching the latest Martin Scorsese movie, The Irishman, on the plane coming down yesterday, and Fat Tony Salerno actually appears in the movie. And why I'm so interested in Fat Tony was in 1974, Fat Tony was indicted on loan sharking charges in New York City. He was running $500 million a day he had out on the streets just in his territory in New York City. He was actually convicted of 14 counts of loan sharking and, in fact, one count of criminal solicitation to have somebody's leg broken who hadn't paid up. The estimate at the time, in the 70s, before we had all these small dollar loans, was that loan sharking was about a $10 billion a year industry in the United States. Illegal loan sharking, that's about $64 billion in today's dollars. To give you a sense, the entire payday loan market in the United States today, online and bricks and mortar, is about 31 billion. So there was basically twice as much loan sharking in 1970 as there is payday loans today. It's kind of there's an outsized sort of focus on payday loans when you consider that it's only a $32 billion business. You compare it to 1.6 trillion in student loans, 700 billion of credit card debt, 900 billion of auto loan debt. It's kind of a weird kind of obsession with these little loans. But whatever it is, the CFPB, their idea was that basically these low-income consumers are trapped into these loans for whatever reason, whether it's they're so desperate that they can't shop, or they're so overwhelmed that they won't shop, or whatever the case may be. But it predicts basically a market value that needs to be rectified here. And so with our data, we test the first hypothesis relates to the market value hypothesis. And we can look at rates, loan amounts, and whether or not there's sort of an equilibrium relationship between rates and amounts. And so this is our data that Tom was able to get. This is from Clarity, who is a company that collected information on alternative lending markets, such as payday loan markets. And we took 2013 as the 1 year of data we used basically to try to keep the state regulatory framework stable during that period, and see what consumer behavior is. And this is all the data that we have. And we got it from a trade association coding for state laws related to maximum fee and loan amounts. So this is where we're kind of reworking the paper a little bit, because we're trying to figure out trying to come up with a better proxy or better measure for state loan caps. Now, there are a few papers on this. There's not a lot, but the papers basically find that it's states that have usually ceilings, that have fee caps on payday loans, that the fees charged, and by fees up to like $15 per hundred is how they do it. They tend to post it in terms of, you know, a certain amount per $100. I'll show you examples in a minute, as opposed to an APR like you do with a credit card. But basically, what they found in these states is that where there are caps, the loan rates tend to rise to the caps. Now, this is the data we have on state laws, and I've highlighted 3 of them here to show the difficulty we've been struggling with since the beginning, and why we're working on this. So these are 3 states we have here. Let's see if it's, so we got California, Delaware, and Florida. And I'm just highlighting these 3 because this is off this matrix, and it says first that this is the state. This is the stated regulatory cap, right? And then this is an example of fees per 100. Now, what is the difference between this and this? And so what we have here is California says it's 15% of the amount of the base amount of the check. So basically, your limit is $15 per $100 borrowed. So, you know, $30 per $200, $45, it's a flat fee. Down here in Florida, we have a more complicated measurement here, right? It's a certain percentage of the amount advanced. So it's the amount advanced rather than the base amount. And then a $5 verification fee before every transaction. So you have this upfront fee of $5 that they're allowed to charge, and then an interest rate on top of that. And then you've got other states that have different interest rates, you know, 15% for the first 100, 14% for the next 100, 13% for the next 100, right? Because you can amortize the fixed costs across them. And then you get Delaware here, which has no fee cap. Delaware has no fee cap, right? So no cap. And so what we discovered was this, just looking at the interest rate on that chart, wasn't an accurate amount of what could be allowed if we converted it into an APR, right? So in Florida, somehow or another, you got to deal with a $5 fee on the first 100 that you don't give to the other hundreds, but that may, in the light. And so we couldn't just use this to figure out the fee cap. So we looked at this column here, which is an example per 100 borrowed. And so if you look here, California says you can only charge 15%. But then the example they gave is $17.50. Now, we don't really know why that is, but it clearly indicates, and in our data, we clearly find that most loans in California are made around 17%, not 15%. So we said, whatever's going on, by which I mean 99.8% of loans are made at above the supposed cap, right? Here down in Florida, it's 15 for the first 100. And like so anyway, we knew that the 15% couldn't be the right number. The number we used originally in the paper was this number here, but it turns out it looks like that's not the right number either. And so as we're reworking it right now, one thing we can say is we couldn't quite figure out what's going on with the caps, but one thing we can say is that states without caps, there are about 8 states that don't have caps, states without caps, we do see a dispersion of costs. So there does seem to be some competition where competition can prevail. We're trying to figure out whether in states with caps, originally we thought that most loans, a lot of loans were made beneath the caps, but now we're not certain. We're certain we didn't calculate the caps, so we have the right measure for the caps. We know the alternative simple measure is also not the right measure for the caps, so we're trying to figure out what it is. But what we do see here, and what this indicates is that you can see that in states, these handful of states that don't have effective or binding fee caps, you see a dispersion of prices from 15 up to 21%. And so there does seem to be at least some competitive cap, that we have some competitive market going on here. The second thing we look at are maximum loan sizes, which nobody's looked at before. And the hypothesis would be here is that borrowers or the lenders would try to make borrowers borrow the maximum amount if they could. The idea of these basically being, if they wanted to create financial distress, that they would have to roll over or something like that. What we found is that's not the case. That there does seem to be some sort of underwriting going on, that borrowers do not typically borrow more than they need, and lenders don't make them borrow more than they need. And so what we find here is that so what we find here is that on this one here, states the fee caps, right, is that that 39% of loans are made more than $99 of the allowed cap in the state, right? 51% are more than $49 under the amount cap allowed by the state. Now, California, as we note in the paper, is an unusual case because California has a $300 fee cap, or $300 amount cap, and 15% fee cap. Now, why is that important? Because what people don't understand about small loans, and this is the fundamental issue to understand in consumer finance, is the cost of making a loan does not scale one-to-one with the size of the loan. So it does not cost 10 times more to make a $3,000 credit card loan than a $300 payday loan. And it does not cost 100 times more to make a $30,000 car loan than a $300 payday loan. Does that make sense? Which is that there are certain fixed costs such as rent, storefronts, lights, time of the employee, filling out the forms, regulatory costs, all those sorts of things that have to be amortized over the cost of the loan. And for a larger loan, that is a smaller percentage of the cost. So as a result, the APR is going to be lower because more of it will be money and less will be covering the cost. For a small loan, such as a payday loan, a huge amount of that cost is the cost of making the loan. And in particular, the way this market works is it's a very expensive business, which is it is storefront. So you've got, they compete on hours, they compete on customer service, right? They have very high loss rates if you're a payday lender, so you've got to do that as well. And so what you have is the cost of making a loan are a very high amount of the cost of a $300 or $500 loan. And so that's why they cost a lot, because the risk is high and the cost of making the loan are amortized over a smaller loan principal than they are for other types of loans. And so California, which has a $300 cap and only 15% fees, allow basically all the loans are going to be made at the cap in California, right? And all the loans are going to be made for $300. So one of the ways, historically, interestingly enough, that lenders evade usury ceilings in states that have usury ceilings, what do? They just simply make you borrow more money. So you might only want to borrow $500, but if the state has a fee cap of, say, 36%, they may say, well, we only make loans for $2,000 and above in order to manipulate the APR, right? And that may actually be a more costly loan overall, but by forcing somebody to borrow more than they want to borrow, you basically can reduce the APR on the loan. And so that's why throughout the paper, we take out California, the California caveat we call it. And so this was the third point, and this is just sort of interesting, is what you see a general relationship in the data between loan amounts and fees, right? And that's basically the equilibrium point. Utah we highlight because Utah has neither a cap on fees nor loan amounts. And what we see is that Utah is above the line, but Utah does not have either the maximum loan size or the maximum fees that are charged in the data. So And so we find some evidence that there's of competitive markets in payday loans. We're still trying to figure out to what extent these are set competitive. Now let's turn to what I think is the more interesting part, which is the effects of state regulation. And this is what really animated us to do the paper, is this six loans a year rule by the CFPB. And so there are two types of rules that we look at. The first one is indicated was fee caps, how much you can charge for each loan. The second is loan amount caps. So a lot of states say you can only borrow, say, $500 or less. We just say California is $300. Other states might say you can borrow $1,000 or have an unlimited loan amount and that sort of thing. And so what do we find here? To give the overview is that we find out that states that have fee caps, low fee caps, borrowers end up taking more loans. And states that have a little bit more loans. States that have loan size caps, borrowers take out a lot more loans. And this is the data, right? So this was surprising to me, which is that states that have fee caps of less than $19 per hundred versus states that have caps where you can charge more than $19 per hundred. Borrowers in these states take on average about 7 loans a year, contingent on taking a payday loan. Borrowers in these states take 8.5 loans per year. Now this was interesting to me that I was surprised that limiting the size of the fees you could charge would lead to an increase in the number of loans, but I think it has to do with your point, Richard, which is what is the effect here? Is payday loans compete in a market with overdraft protection or pawn shops, or particularly overdraft protection is a very common thing, because both payday loan borrowers and overdraft protection, you basically have to have a bank account in order to have this. And so there's this wonderful paper by Morgan and Meltzer, I think it is, where what they find is that consumers actually shop rationally in deciding whether to use a payday loan versus a overdraft protection. It has to do with the way that the products are priced, which is we see payday loans are priced on a per $100 basis, so $15 or $20 per hundred, whereas overdraft protection is primarily a large upfront fee, say $29, and a very nominal fee on the back end, right? Does that make sense? So what the logic here, I think, might be is that when you cap the cost of the payday loan, and so let me close the loop. So for a loan, if you've got a loan, say, below, I think, $180, it's cheaper to take a payday loan to cover the obligation. For anything above $180, it's cheaper to use overdraft protection because of this flat fee component of it. Does that make sense? And so what they find is in states that outlaw payday loans, you not only see people use more overdraft protection, but the average size of the transaction that you use overdraft for actually declines, which is kind of a cool result, right? And so our speculation here, and it's purely speculation because we haven't seen anybody else make this finding, is that maybe that basically by putting caps on the size of payday loans, people demand more payday loans because they're less expensive than they might otherwise be. But that's kind of an interesting finding. And what we find here is Kolovach, I think this is a distribution of states. So that what we see here is that the states with the blue states are states in the number of loans per person. This is just kind of a visual. We see that most of the states, of the 30 states we have, the top 15 are primarily states that have fee caps below $19. And down in this end, we have red states with fee caps above $19, which is interesting. This is the one I think is the most important one, though, because it's such a dramatic effect, which is low amount caps equal more loans. And here, the difference is quite striking. That was 8.5 versus 7. What we have here is that in states that only allow you to borrow 5 on average in states that have loan amount caps. And what's going on here is fairly obvious, which is what?
The amount is per loan. So the cap is per loan, not
The
total.
cap is per loan, right? So basically what it is people have a demand for a certain amount of credit. They have a demand for a certain amount of payday loan credit. So what do? They just have to take more loans to get it. And it's as simple as that. And we know demand for these fringe lending products is pretty inelastic. We've known that for a long time because these are credit constrained consumers. They only use payday loans like if they're tapped out on mainstream credits such as credit cards. And so all we end up doing is increasing the number of loans they take. And quite striking in that way is that the total amount, see if I have
They pay more fees, right?
the total, yeah, they end up paying more fees, probably, right? Yeah, because they're taking more loans, right? But the average amount that people borrow on payday loans in the low loan cap and the high loan caps, they end up borrowing the same amount. So they actually get the same amount of credit. They just have to take 9 loans rather than 6 loans in order to get the credit, right? And so that's what we find here, is we find no statistically significant distinction between states with low caps or contingent on taking a loan. They take about 3,139 with that standard deviation. States in high caps, it's about 2,700 with that standard deviation. So the effect of loan size caps simply is to get people to take more loans. In an appendix in the paper, we're trying to, if these statistical whizzes have any thoughts on this, maybe send your comments to Todd, because he's the one who figured this out. We try to figure out by a regression analysis, a lot of states have both loan caps and have fee caps and loan amount caps. So we try to do an interaction calculation in the paper. And that's in an appendix, and I'm not going to try to explain it because that's why I partnered with a finance professor on this paper. But what we see here is the same sort of dynamic, right? States that have lower caps on loan size take significantly more loans, right? And this is illustrating that as well, right? The final thing we look at is this Veritech Database. I think it's a little less interesting. This is something that some states have adopted that basically keep you from taking more than one loan at a time. It's a centralized database. And we do find that that does, in fact, reduce the number of loans that people take. Is if they can't take more than one loan, they have one payday loan in a given time. But this goes back to the question of whether or not those consumers are better off as a result, because over time previously it seems to have the same demand for credit is what they take. And so what is interesting then is, if you think about this, it's particularly focused on loan size, and states with low loan size caps, borrowers take 9 loans per year. Those with higher caps take 6 loans per year. They borrow the same amount in a given year. What about the CFPB rule that focuses on the number of loans per year as a significant regulatory question? And in particular, is that a useful proxy for financial distress? The CFPB is trying to check them. And the answer seems to be obviously no. Right? In terms of sort of simple arbitrariness, which would be the standard of review for law under the Administrative Procedure Act, it seems like this is a completely arbitrary rule. That the exact same consumer in state A would be affected by the law, but not in state B, simply because in state A, they might have a lower loan amount cap than they do in state B, right? And so what we see here, right, 51% of borrowers, and this actually then looks at the borrower level, 51% of borrowers in low amount cap states would be affected, 44% in high cap states would be affected. Utah, which has no limit on low amount, only 21% of borrowers would be affected, even though basically in all these states people are taking the same amount of credit in any given year. And so I think this is really important for the regulatory question, the litigation that ends up coming if they bring this back, because this effort to try to use number of loans as proxy for financial distress just doesn't seem to work. So with that, that's the paper. I'd be interested in comments, feedback, and the like.
So a question on the, financial distress of the consumers. Is there value in trying to look at other markets, how the regulations and the differences affect other loan markets in the state? You know, for example, if it is the case that states that have certain higher regulatory barrier for payday loans, somehow, that puts people in shape. They don't borrow more than they should and whatever, right?
Yeah, right.
Well, that should have a positive impact on the car loan market. It should have a positive impact on the mortgage market because they are not, and when we were talking about consumers, you can have the credit card debt market.
Yeah.
At least you should see an impact there. Is there any attempt to connect the two and see, well, if they don't get in trouble with payday loan or lending, they might, behave better than credit card? My guess is no, there'll be no impact in this market because of the total demand for it.
No, it's great. It's a great question. There are a lot of papers that try to get at that. They try to get at the interactions between these markets. So one famous paper is by Garrett Morris, very interesting paper, where they find that access to payday loans increases resiliency after like a natural disaster, right? That basically, everybody knows Waffle House is the first place that opens up after natural disaster. My guess is the payday loan market shops are probably the second one that opens up after a natural disaster. And a lot of it has to do with bridging this gap, right, between the time you get the money and the other things. So you would expect that, for example, at the beginning of the pandemic, when people were waiting for their pandemic relief checks, right, you would think payday loans would probably increase. So we know credit card usage increased during that period, for example, right, because people have liquidity issues, right, and so it's useful for that. There are a lot of papers that try to look at these interactions that you're talking about. Paige Skiba and Vanderbilt has looked at this, and some others, and it's all very messy as to what the overall effect is. So some find that the states that have payday loans have higher bankruptcies or lower bankruptcies, or no difference in bankruptcies, effects on defaults, on other sorts of things. One paper does find, interestingly enough, that access to payday loans, and in particular being able to roll over payday loans, has a positive impact on credit scores. And basically, even though payday loans are not reported to credit bureaus, which is one big reason why consumers take payday loans, is because it basically offers them a free default without impact on their credit score. We'll come back to that in a second. The fact that you can use a payday loan to pay off some of your other pressing bills, right, that do get reported to credit bureaus, basically can help you from getting your credit report dinged, right? So that seems to be the case, but the real effect is it's really hard to tell. And partly I think, Carlos, is for two reasons, which is, number one, payday loans are sort of a life raft of last resort for people. So what they find, for example, is that basically when you take a payday loan, your credit score is already in the downward trend, right? You've got a 520 credit score, right? You're on your way down. But so trying to figure out whether or not you're going to file bankruptcy after that, if that's caused by payday loans, or payday loans are just a casualty as you're descending into bankruptcy is not quite clear. So trying to get your hands around a lot of that is hard to tell for overall financial distress. And then the other question is sort of what do people use otherwise when they don't get it. So there are a lot of papers. My read of the literature is that it's really ambiguous and unclear. That it's really hard to control enough the variables to determine whether on net access to payday loans is good overall or bad overall. My intuition is that it's very good for a lot of people, and for other people, it's probably not that bad. And the second thing I should have mentioned is these are small loans, right? It's unlikely that a $500 or $600 loan is going to break your back, number one. Number two, one of the problems the CFPB has in their whole approach to this is they've got, I'll just say, the wrong model of consumer default. which is they think on everything the consumers default purely out of financial distress. I think that is clearly not the case. Sometimes that is the case, but if you look at the mortgage meltdown in the late 2000s, for example, there's a lot of strategic default going on there, right? Their house was underwater, it was a bad investment, people walked away, right? And we know they'd be changing incentives. So Texas, for example, where they have these non-recourse laws or anti-deficiency laws, if housing prices fall, people are more likely to walk away because you can't seize the assets in the bank account, you can only take the property, right? So that makes default a lot less costly. And when it comes to payday loans, it's not clear why if people ask why are defaults so high on payday loans, that's the wrong question. The real question is why are defaults higher, right? Considering there's, three things can happen when you default. You can get your credit score harmed. Payday loans don't revoke your credit scores. The debt collectors can come after you. Payday loan lenders rarely hire the debt collectors because these people have no money.
And a small amount too.
And a small amount, so it's not worth the cost, usually.
The kind of big
right?
That's expensive.
Baseball. Or they sue you, right? And it's not worth the cost of suing you because you can't collect anything because they don't have any money, right? And so why do people not default? The reason seems to be, and this is something I want to do more research with Todd, the reason seems to be is the effect of defaulting on payday loans. Basically, you can't get any more payday loans from that lender, right? And that's the cost.
You want to have that option.
You want to have the option, right? So but it's clearly an option that people are rationally choosing. And so, for example, consistent with this, the overwhelming number of defaults on payday loans are before somebody even makes their first payment, right? They basically borrow the money and never plan on paying it back, right? Sometimes people pay for a while and say that's enough, right? And the lenders say, yeah, that's enough, right? And they let it go away, right? But these people are not fools. They don't have a lot of money, but they understand what they're doing. They understand the option. They understand that this is their credit of last resort because next down the line is a pawn shop, basically, and pawn shops stink, right? They're just bad credit products because you got to give stuff away. You can't borrow very much money, and so they're trying to preserve an option of keeping this line of credit open. And what ends up happening, we talk about this in our book, Consumer Credit, American Economy. It turns out these fringe loan products, these alternative lending products you age out of them. They basically, early in your financial life cycle, you have a high demand for this credit. Why? Because at that point of your life, you have a very high demand for credit when you're young, and a very low supply of credit because you have no assets, your income is low, you have no established credit score, right? And so you have a high demand but a low supply, so you tend to use these, but as you get older, you age out of these products, you get credit cards, you get higher lines of credit, you get houses, you get all these different sorts of things. And so partly, and so they just happen to be lower, lines of credit just happen to be lower income. They're temporarily lower income. They're not stupid, right? And they understand what they're doing here. So
Kind of like a minimum wage job, right?
that's a great example. It's a great analogy.
Minimum wage job, they don't end up having
That's right. Most people don't support their a family for their entire lives on a minimum wage job. It's an entry level job that you go up. And this is one of the things that I did the CFPB task force where I was chair, and this is the essence of the entirety of consumer finance, which is people think of consumer credit as just being about consumption. It's not. Mostly what people use it for are capital goods. A house is a capital good, right? An education is human capital. A car is a capital good. But most people don't think about it. A washing machine is one of the greatest investments you'll ever make in your life. Think how valuable a washing machine is compared to having to go to the laundromat every weekend with a pocket full of quarters, right? How about a stove? How about a refrigerator? How about a television, right? Think about all these things. These are all capital goods that make sense to use finance, right? It was very funny in the 20s when General Motors overtook Ford as the largest car dealer. One of the reasons was Ford only made Model Ts, and General Motors was nostalgia. The other reason was General Motors rolled out the GMAC plan, where you could buy a car, finance it, and drive the car while you're paying for it. Ford responded by allowing you to buy a car on layaway, which is send us a check every month, and after about 10 years after you've saved up enough, we'll give you a car. Meanwhile, ride the bus. right? It's like, that doesn't make any sense. It's a capital good, right? It'd be like a business saving up to buy a backhoe, for their construction industry, right? And so once you start unpacking a lot of this and you start understanding how consumers use credit, why they use it, you start to understand these life cycle aspects of it. Earlier in your life, you're a borrower. You reach middle age, you become a lender, right? That's when you go from borrowing to basically saving and investing. So you basically go from being a borrower to being a lender as you progress through your financial life cycle. And at the end of your life, you start dissipating your accumulated asset. Yeah.
Do we have information about what a typical relationship with a payday lender looks like over time? The premise that people pay back and they want to maintain the line of credit there means that they're anticipating using them again. But if you're using them often, it's not going to be sustainable. So what level of repeat buying power do they have? Do you know anything about that?
Yeah, so and so that's why you're trying to estimate what the impact of this rule would be, which is that as you can see in the data, continue on taking a payday loan. People take a lot of payday loans, right? 6, 9, or whatever the case may be. And so it seems to be the case is that they use payday loans for a little while in their lives, and then they kind of age out of them. But they do use that pretty frequently during these periods of their life, and that's why we don't like it, right? Which is, this isn't a product that is really suitable for people to use for a long period of time, right? It is expensive. And the question is, well, what do we do about that, right? Because what we know is these are people, when you ask them why they're using payday loans, they do use them a lot for sort of recurrent expenses. When you ask people why do you take a payday, what's the alternative payday loan? It's eviction, it's having utilities terminated, it's getting your kids kicked out of childcare, right? Some of it is for emergencies, clearly, medical expenses and that sort of thing. But a lot of it is that there's just too much month left at the end of the paycheck, right? And so people are using it as a liquidity product fairly regularly. And the question is, we'd like to have alternatives to that. I think fintech is potentially a very powerful alternative, because one of the things with this is it's such a lumpy product. Everybody gets the same price. They do really, these repeat borrowers do provide the products, right? Because a client acquisition and starting a new client is very costly. Like I said, a lot of defaults before people are making payments. So, and so these repeat customers allow you to amortize the fixed costs over time. You don't have to go through all the recruitment of them and that sort of thing. And so that looks suspicious, right? It's not clear that it's as suspicious as it looks, right? Because credit card issuers have exactly the same model. They want you to revolve your debt, right? Mortgage companies want you to pay. I mean, think about it. Do you realize they want you to pay thousands of dollars for 360 months in a row that you have to pay on a mortgage, right? These are much more expensive. So, and so, so consumers, consumers basically say, I know payday loan is expensive, but it's better than the alternative. A handful of consumers basically say, I wish I'd never got involved with the payday loan. And so, it's kind of a love-hate relationship. They know it's expensive. So I'm not sure if I'm answering your question.
Yeah, usually how they, whether they like or don't like it, or regret or don't, and I'm thinking like what's a portrait of a typical repeat user who is, doing well and getting any kind of using it. Like,
yeah, right.
He has a car, just painting a picture of a guy who's taking out 6 to 9 of these a year.
Right.
5 years from now, he's going to be in a different financial situation.
Perfect. Yes. I got it. Yeah. So they're, yeah, no, well, it turns out that typically, the women do tend to use payday loans more than men. Yeah. So women.
Single
tend to-
mother, probably.
Single mothers, yeah, in particular use payday loans, because of, their finances are just very unstable, right? And so a lot of these payday loans, these lump sum products are designed for these people who have, sort of fluctuating income. So you can think about, a maid or somebody like that, right? Who may have up and down earnings, depending on how many houses they clean in any given time or something like that, right? So a lot of them are single moms. In general, they are working class, which is to say lower middle class. They're not poor. They're not middle class. They can be lower middle class. They tend to have some college a lot of times, right? They tend to be younger on average. They are, one thing that's characteristic about them is they do have bank accounts, right? Because you need to have a bank account that you can draw a check or a payment against. So in that sense, they're different from pawn shop borrowers who are a lot of unbanked consumers. Or interestingly enough, I also did a paper on auto title lending. Turns out auto title lending is very popular with unbanked consumers, and particularly immigrants, right? For whatever reason, immigrants, including illegal immigrants, can get access to cars, right? They get cars and driver's licenses and some of that sort of thing. But they can't get bank accounts because bank accounts are supposed to, you've got to do all this paperwork in order to get a bank account. So they use pawn shops and life. So we're talking about our young, often female, working class, with financial kind of earnings and stability, that end up taking these things. So you do get some use them over a long period of time, but typically it might be, say, a single mom right after she gets divorced would be an example, right? Of somebody who needs time to get their finances in trouble, or somebody who's just started working and doesn't have any savings and that sort of thing. So, but I think that's kind of an accurate view. They're not the poor of the poor, but they're certainly not financially successful.
Either for large one-time expenses compared to their income, they move out for a few months, or for regular expenses, rent or whatever, if their income is very low, they can pay in the back month.
That's right, and that's the sense in which my friend Michael Forrest did a paper that I have in mind on overdraft protection. And one thing that was very striking is that contingent on using overdraft protection was actually positively correlated with the amount of money, or like I think it was the average balance in your account or something like that, or something. I don't remember exactly what the variable was, but basically overdraft protection is used to deal with variability, right? Between wages and expenses that people have. So people who use a lot of overdraft protection are either those who are credit impaired, or people who just have a lot of money flowing in and out of their accounts. So you can, often that'll be a higher income person, obviously, but it may be like a salesman, right? Who gets paid on commissions on a month-to-month basis or something like that. So income is unpredictable, but in there, the expenses are predictable, but income is unpredictable. So since here, you've got both variability in income and expenses a lot of times for a lot of these people. So.
Two questions. One is, we're talking about sort of bias in research as we discussed earlier today. And it strikes me that there's a lot of positive research or micro lending in development economies. Love that stuff. There's a lot of positive outcomes. Which is questionable now after a lot of those things don't replicate apparently. But there was always, at the beginning of the literature, there was a very positive, micro lending, how useful that is, and so on. I don't know exactly the terms of the micro lending, but the point is that providing people access to short-term amounts of money is very positive for their planning, for whatever, right? And then here we have a literature that, for the most part, is very skeptical of the value of the availability of those small loans. And it's because that's mostly done in the private sector versus something that's done on, the Gates Foundation doing it or whatever, right? Is there anybody who's trying to say, listen, the same mechanism that makes the potential microcredit a very important positive intervention is the mechanism for which people benefit by the accessibility to the income?
Yeah, so that's a great point. I mean, and I think a lot of it is non-economic. It's that microlending feels warm and fuzzy, and payday lenders don't, right? So, I mean, it's like they just use the term payday and predatory lending interchangeably, right? Yeah, this is expensive, right? These are expensive loans. The APR is about 391%, right? It's a lot more expensive than a credit card, and default rates are high. But it's an assumption or a norm, but normatively, basically you got to make the lead that basically, well, why do people default, right? Why are costs high? What are the alternatives for these people? One of the things that's interesting is what's become the darlings now are installment lenders, where you borrow a certain amount and you would repay it over, say, 12 months on a fixed payment schedule, and it's self-amortizing. So we don't have these balloon payments at the end that cause people to have to roll over. Well, what's kind of naive about that is simply putting somebody on a repayment schedule doesn't mean they're going to stay on the repayment schedule, right? So usually what will happen is somebody will pay for 4 or 5 months, and then they'll get some sort of hiccup in their finances, right? Then they get hit with the variability, because it's a lot of the same people, sort of working class people. And then what do you do then, right? The putting on an installment payment schedule doesn't reduce the variability in their income, right? And so then that's where the cost comes in. You got to start working the account. You got to try to keep them from defaulting. In case, I think we have a footnote in this paper, maybe it's another paper, but it takes something like 40 phone calls to try to work out an installment loan with somebody who's a delinquent borrower, right? Because they're not answering the phone when you call, right? If you call, you've got to negotiate. Can you pay $10? Can you pay $15? Right? There's all these sorts of things that go into it, and so there is kind of like a jockeying that's going on here, right? I think the micro lenders, the default rates are low simply because of reputational stigma. If I understand that literature, right? Here, that's not the case. And one of the things we see here, for example, is defaults on online payday loans are crazy. It's like, I don't even know how those guys make any money. Like, the default rates are like 45% on an online payday loan, right? Partly it's because of fraud, because people can just constantly steal social security numbers and keep applying for online payday loans, right? But partly it's because it's totally anonymous, right? And so you lose these social relationships that cause people to make good on these loans. And so I think there's kind of this dreamy sense of which, this is embedded in a network of personal type relationships, and that's good. Here, there is this kind of, market kind of headbutting that's going on here, right? Where they're trying to get you to collect, and you don't have the money, and so it just looks a little bit unseemly. Now, one of the things we know is these people, what a lot of people who don't like payday loans say is, well, you can just borrow the money from your friends and family, like microlending, right? Well, number one, if you're poor, most of your friends and family are poor, so they don't have money, right? Number two, if your credit score is 520, it's not like that's not the brother-in-law you want to lend money to, right? I mean, it's like we can tell these stories. But number three, a lot of times people don't want to go and tell their friends and family, I'm in financial distress, right? I don't have enough money to pay the rent, and base themselves in that way. And so, they assume a sort of framework around sort of this micro lending and the relationships that may not be accurate now people actually experience it, and people might actually prefer this. In the sense there's almost some dignity to this that there isn't when it comes to begging your brother-in-law for a short-term loan or something like that. So, I've worked a lot of the micro lending stuff, but it's definitely right that they portray it as different from this. They portray it very much like they portray borrowing from friends and family in these situations.
Yeah, the question was a public choice question. So this seems to be a market that there's very little barrier to entry. Sure, there's inelastic demand, which means that there's power on the supply side, right? But at the same time, it's as you said, it's very competitive. People get in and yeah, there's like an enormous regulatory oversight, and it tends to who's the special interest here that is pushing to get you guys out of business? Is it banks for the overdraft?
partly it's the banks for the overdraft. The banks are always on this, and overdraft is very profitable, for the banks.
That explains.
Yeah, so the banks are a big part of it, which is basically, and that makes it easy for people to raise it, even the industry, the banks.
are supportive. James Diamond likes
Yeah,
this.
right. Even Jamie Diamond likes this. So, yeah, it's like, so they'll throw the payday lenders under the bus so they can keep charging you $34 for an overdraft, right? Yeah, that's part of it, but a lot of it's just ideological, right, which is.
Sounds bad, right? So, yeah.
Yeah, it just sounds bad. It's sort of upper class bias type of things, right? It's like people who don't shop at Walmart hate Walmart. People who don't use payday loans hate payday loans. I mean, a lot of it's just as simple, as simple as that, as far as I can tell. And so, there is this sort of racial valence to it, right? The minorities do use payday loans. Hispanics, minorities are often more likely to use because of these demographic factors and things like that. And so it's easy to kind of tell a story about this being predatory, stuff like that. Why is the CFPB so obsessed with it? I don't really understand. Richard Cordray was totally obsessed by it. And he was running for governor of Ohio when he was head of the CFPB. And this was one of the scouts he put on the wall. He wanted to, when he was going to show that he was the champion of the little guy and that sort of thing. But yeah, it's just an unpopular industry that upper middle class, white people like to demonize to show how enlightened they are. But then you really kind of think about what happens next and whether they're actually making people better off. What used to be the public choices is hilarious, or this great quote from Robert Samuelson, right? Paul Samuelson was the Nobel laureate, right? So Paul Samuelson actually testified in the Massachusetts state legislature in the 1960s on the Uniform Consumer Finance Act, Uniform Consumer Credit Act, or whatever it was, which proposed to eliminate usury ceilings. And Samuelson, in his testimony, said basically the economic consensus is that usury ceilings hurt the people it's supposed to help. So who supports it? He says history is replete with examples of organized crime in the mafia supporting unrealistically low usury ceilings in order to keep the market for themselves. So I'm not sure that they're the special interests who are working it now, but back in the past, that was the dynamic, right? It was a Baptist and bootleggers dynamic where these edgy, big city organized crime bosses favored restricted usury ceilings, like Pat Tony, like I was saying earlier. It was a huge revenue source. 1968 Senate report by the United States Senate found that loan sharking was the second largest revenue source in the mafia. The only one that's bigger was organized with gambling, but loan sharking was more profitable, so they actually took gambling revenues and invested it in their loan sharking operations because they would get a higher rate of return. So that's what the real thing about the mafia traditionally lobbying for this stuff.
All right. On that, thank you.
Thank you.